Hello there and welcome to Vienna, to the OPEC headquarters. This is the edition of Oil Market Insight, coming to you on the occasion of the 169th OPEC conference. And we're coming to you here from the press room at the OPEC headquarters. Here, of course, the venue where many of you will be familiar with listening to the OPEC decision always after the OPEC meeting, where the press conference is held right here. So here at the very, very hub of OPEC, we're here to look at Oil Market Insight, and my panel of experts here to help us. Let me quickly introduce you to them, and we'll get right down to it. Jason Schenker joins us from the US. Jason, of course, is the president of Prestige Economics from Texas. Now, Jason, I know I always have you as the spokesperson for the US when it comes to what's going on the market there, but you're watching, obviously, the world, but watching the US market very, very carefully. A lot of oil has come off the market, a lot of production has come off. Bring us up to date with what's going on in the US.
Well, you know, we've seen about 425 to 450,000 barrels per day come off in the U.S. just since the beginning of the year. So that's a big drop. And as we look forward, even if prices remain where we are now or a little higher, around $50 a barrel is still a price point at which you're going to see continued bankruptcies, you're going to see layoffs, defaults, all kinds of problems in U.S. shale. So you're going to continue to see those problems even if we remain at this price point. And to concur with what Gaurav and David have said, as you look out 2 or 3 years, I think there's a lot of upside for prices because you have the potential for reduced Capex in the short term to limit prices as global demand continues to rise.
But when we look at oil demand also, Jason, we're seeing that the oil demand growth, the additional demand growth, that has actually come off quite a bit, really, in the past 2 years. I think maybe about 2 million barrels, really.
Well, the oil demand growth this year we think should be solid. I have a slightly higher estimate than what David's saying. I think we'll see 1.5 million barrels per day extra. But, you know, I think you're going to see low prices cure low prices here, and that should be solid. I know we're seeing in the U.S. very strong demand. We've had record miles driven. They do a 12-month moving total basis on what that since December 2014. We've seen records month after month after month. Summer driving season this year is going to be really strong. And OECD demand had been something that's been in decline since 2005, but you know, this pop in demand is really being engendered by those low prices, and that's going to help bring the market, I think, back into balance.
What do you think, Jason?
Well, I think that I would agree with David's point about there's different price points at which you're pulling the oil out of the ground. And this is, I think, where we need to differentiate between operating expenses and Capex, capital expenses. And on the OPEC side, there's a very big difference between what it costs to pull the oil out of the ground, and a lot of the shale plays are in the money at this level. But the problem is on the OPEC side, on the Capex side, where are you going to be able to make additional new investments? And back in November, on November 5th of 2015, the Fed, the FDIC, and the Office of the Comptroller of the Currency, 3 critical regulators in the banking side, issued a strong warning about risk to the economy because of leverage lending in oil and gas. And this warning was really important because it sent a message to the banks to be very, very careful about issuing additional debt in this space, which means if you're going to get more drilling, the Capex has to come from somewhere, and it's going to likely be shut out on the banking side for some time. It means it has to come from other sources of investment. So while OPEX-wise companies might be doing better, Capex-wise they still might not have the money to drill those wells, and we're looking at a lot of operators that could potentially lose pay zone leases, the ability to drill in some of the places where you've got good rocks. You might even lose those because they can't get the money to drill those wells, not even at $50.
Again, the investment side, very important. But stay with us here on China at the moment and the growth that we are seeing there. Obviously, it has tempered quite a bit in the last few years. It's steadied, but there is still growth there. And we look at the strategic reserves as well. China has been topping that up.
Well, that's while they have been adding to their strategic reserves, and their oil demand growth is likely to continue. That's because of an emerging middle class, and that is, to get to what David's talking about, that's an aircraft carrier that's turning. You're not going to stop that trend. The manufacturing side in China has been very weak. The data through May reflect a manufacturing recession in 17 of the last 18 months. You've seen month-over-month contractions for a year and a half. But even though that's been going on, the oil demand growth and that emerging in the middle class is still going on because manufacturing Manufacturing is 31% of the economy, and the other 69% is on the consumption side. And that rising middle class is going to continue to demand more crude. It's going to continue to demand more cars. What that does to the overall Chinese economy is up for debate, and there are downside risks for the Chinese economy as a whole. But this long-term trend of continued fuel consumption by individual consumers, as you have this massive emerging middle class, that's not likely to change anytime soon.
And again, the monetary issues in Japan, they're looking closely at that at the moment too. It'll be interesting to see. And we'll come on to the monetary issues and the Fed, be it Japan or be it the US as well. How's that going to impact?
Well, I think that obviously what's going on with monetary policy, we're at an inflection point. Before we go to that, I would just say one thing about what Gaurav just mentioned, and that if you look, OPEC publishes their expectations for forecasts for the next 25 years for where oil demand is coming from, and over 70% OPEC is forecasting is coming from India, China, and other Asia. So this is where this is all coming from. And monetary policy in Japan, I think, is going to be maybe less critical for the oil market, and I think that's even true with the ECB, which I think is eventually going to wind down its quantitative easing. You've seen improvements in manufacturing in Europe, and although people often talk, and I hear it in the States, they're very quick to say that manufacturing growth in Europe is quite slow. But for 9 of the past 10 months through April, European manufacturing improved month over month at a quicker pace than U.S. manufacturing, or it improved while U.S. manufacturing actually was contracting. So things in Europe are getting better. In the U.S., you have a risk of a Fed rate hike. I think they're going to wait for July. The June Brexit risk, which I don't think there will be a Brexit, but the risk to the entire financial market is something that would make the Fed wait. The point is the Fed is in a tightening mode, and the other central banks are still in a highly accommodative mode. This is something that could make the dollar strengthen and cause a bit of some choppy trading and pricing for oil and other commodities through the mid-year, but it's also something that's going to engender some slowing of growth later this year and next year in the U.S.
And again, that's what everybody is really looking at, just keeping some strength in the market and keeping that demand. Looking at the U.S. in terms of the demand figures that are there, and looking at the growth. And again, it's not all spread out even. And when we look at the manufacturing numbers, various numbers coming out of there, it's not an even picture coming from the U.S. either, is it?
No, it's not. There are pockets of recession, and there is in U.S. oil and gas. To give you some idea, and this is something that actually poses upside risk for oil prices. In Texas, for example, in December 2014, there are about 320,000 people employed in oil and gas. And the most recent month's numbers from March show there were 230,000 jobs in oil and gas. You lost 90,000 jobs, almost a third of the jobs in the oil and gas space. It puts you back to job levels at 2011 levels. Essentially, any jobs created in the shale period are gone. Manufacturing has been quite weak. Industrial production year over year, that's very weak. There are also some concerns about, I think, auto sales, because retail ex-autos is at recessionary levels. But if you look at auto sales, they've been very strong, but that's because of subprime auto loans. So there are some mixed things. Rail car loads are weak. Trucking's been weak. Anything industrial's been weak. But in manufacturing is only 13% of U.S. GDP. It's a very small number, especially compared to where China, it's 31%. But these are providing headwinds, and I still think that this is, a general concern for the global economy. Last month, over a month ago now, in April, the IMF released their growth forecast. In the press conference, they were asked if the global economy was in a crisis. One of the heads of research said, "We're not technically in a crisis. We're on alert for a crisis." Not very inspiring statements, but again, to David's point, if we look at oil demand growth has been good, and the biggest driver there is low prices cure low prices, and so you're still seeing solid growth there, while things look less good for copper or for ferrous scrap or for other industrial metals or for general global economic growth, which this year global economic growth could be below 3%, which is consistent with a recession level, even though it's still 3%. But for the global economy, not a great year. Oil demand growth could be very good.
When we look at the state of investment, and we take into account too the state of the employment market and all of that too, the investment that's come off the market, many of the analysts saying 1.5 trillion in the last 2 years. Gaurav, I'd like you to look at this. That's a lot of money off the market, and it's a lot of money that probably will not come in. Where's the big danger now that that money is off the market, investment has really been taken off, projects cancelled, delayed? When we look maybe a year or two down the road, I mean, could that indicate another price spike What's the big danger of this money gone off, and the fact that maybe investment doesn't come back? I'll have you all address. Jason, that issue on investment.
Yeah, I see upside. We look out a couple of years or so. I mean, I think growth in the U.S. and globally could be spotty over the next year and a half. But if we look out into 2018 and beyond, there's a lot of upside risk. I mean, the number of discoveries in the last year was the lowest it's been in 50 years for oil. Number of new discoveries. This is the level of investment is going to remain very weak. And I think in the U.S., again, you have the financial services regulators, the Fed, the FDIC, and the OCC, that issued very strong warnings to banks about whether they should be investing in the space. That warning was issued on November 5th of 2015 when the closing price of WTI was $45.20. Right? In the first quarter, it was the price, the average price was 30% below that, and we're just now a few dollars above that. So we're just now back to a level that made the regulators very nervous about the banking system, which means the banks are going to be loath to put a lot of money into the space on a debt basis, which means you're going to look at money coming into the space from private investors, private equity. They're going to want very high rates of return, which means you might need to see the price go a bit higher before you see a lot of money come in as an influx of Capex, which again delays that additional marginal supply you need after the market comes into a balance.
Indeed, everybody feeling the pinch. I'm going to leave you with the last word on this, Jason. A lot of challenges out there, of course, but as we look ahead towards the second half of the year, where are the bright spots?
Well, I think the bright spots are you're still going to see Europe manufacturing here likely to continue to improve, growth continuing to improve, remains solid, job gains improving. So I think Europe gets a little bit better. I think that's a bright spot. I think for oil demand growth, the emerging markets, China, India, those are going to remain solid. Global demand, U.S. demand should be solid because of the low prices. Summer driving season should be really strong. I think those things are good moving forward. I think as we look further out, to get to something that Gaurav just mentioned, as we think about drilling, and to tie into what David said as well, the additional oil could be drilled, but if the people leave the space, if I think about just what's happened in Texas, where a third of the workers are now gone, if you need to bring them back relatively quickly, what are you going to do? So that could be a challenge moving forward, and that could put costs back in to the system. So I think that there's going to be a circular feedback loop there, and I think also future expectations feed through to the present, right? You also have, because of the forward curve, the ability for future expectations to be priced into the present. So I think that we do see some upsides for the underlying, for the price of oil, but I think for global growth, I think things are a little bit more touch and go for the next year and a half, and the same for the U.S.
Well, we have to leave it there. So, gentlemen, thank you so much for joining us. Jason Schenker, Gaurav Sharma, and David Weck. Thank you all so much. And again, that was it, this edition for Oil Market Insight. Thanks so much for being with us for this. And as you can see there, it's a volatile time, very uncertain time as we start the second half of the year 2016. So here on the occasion of the 169th OPEC conference, we're going to leave you from Vienna. Thank you so much for being with us, and stay with OPEC.org for more information. Thank you.